This is Tom Asp with the Viper Report for the market wrap video for June 28th close, also end of the month and end of the quarter. So subscribers will be updated on the new quarterly pivots that will be following from now until the end of September. Those of you who've read my articles in Forbes will see how important these levels can be as both support and resistance. This is a monthly chart of the NYSE composite, the broadest measure of the market we've been talking about. You can see it was down 57 points for the month, 0.32%. More importantly, underneath this, we can see that the rising 20-month EMA, major support, is at 16,619, and we closed at 18,025. So almost over 1,500 points below current levels. In an uptrend like back in here in 20, after the initial bounce off the COVID, that level would be good support. I don't think we'll get down there before we move higher, but it does allow for some room on the downside. More importantly, the monthly technical studies, that's what we use to determine the major trend of the market. That's like, your 401k or, whatever retirement fund you have. Are you in stocks or something else? Right now I'm in stocks. I was in stocks, up until the summer of 2007, then moved into a bond fund and precious metals. So we see no signs of a top here. This is the NYSE stocks only, made a new high last month, and the NYSE all, which includes not only the stocks in the NYSE composite that we discussed last week, but also bond funds, etc. The weekly chart, we can see that for the week we closed up a bit. All right, last week we pointed out that we bounced from this 20-week EMA, which is at 17,754, and we needed a higher close here to suggest that this was a pullback in an uptrend. Oftentimes you will see this sort of pattern. We got quite extended 6 weeks ago, and now we're back to support. Volume did pick up last week, not surprising, end of the quarter, etc. Window dressing. So you always see that, for those of you who are not too familiar with some of the factors about how the market operates. Often fund managers who have missed the boat, which often they do, will move in the last couple of days of a quarter to be sure they have all the right stocks in their portfolio, and even though they probably are not getting in at the best possible price. So stocks only AD line turned up from its moving average, higher highs. That's all positive. We're still would like to see a sharper up move to indicate that we're going to accelerate to the upside and maybe break out of this formation. Didn't see it. So, if we were to get a week of very strong selling, you could knock this below the moving average and back to that support. You wouldn't want to see 2 consecutive closes on a weekly basis below that support. So that was the stocks only. NYSE all, it looks even stronger. You can see it held well above its moving average. So that's all good in terms of the weekly trend. Though many are worried and warning about a sharp correction, which is always a possibility, we don't see the weight of the evidence shifting that, but that could happen. Here's one thing I follow. This is the S&P 500 VIX. In April we had a nice job here of completing the bottom formation for this correction that lasted a few weeks into the middle of April. SPY, you can see, pushed to a new high and then closed lower, down 0.41% on Friday. That's unhealthy. So the 20-week or the 20-day EMA is 54.13 on the S&P. So, and we're at 54.60. So roughly, 50 points below where we closed. So that's your potential downside right now, and also down to 5,400, which was this high here. You can see the VIX typically is still in a downward range. So when this is falling, that's bullish for stocks. When it's rising, it's bearish for stocks. And you can see the liftoff, from the great buy signal from last November. You can see what the VIX did. And so, we'll be watching this on a daily basis, see if we move above this peak and then above that resistance. This is the Volatility X on the NASDAQ 100 options. It's also low below that resistance. So neither of those are saying, time to go short or time to buy inverse funds. Last week we talked about equal weight versus weighted averages. You can see this is the S&P 500, not adjusted by size of the companies. Of course, we have, Microsoft, Apple, bunch, Nvidia above $3 trillion. This does not show up, and they're all equally weighted. You can see it's been flat, pretty much, going back to the start of the month. And you can see if we flip this to a monthly chart and see what the difference has been, you can see, it's down 0.65%. This will be important once we look at a weighted. You'll see the big difference. But back to the daily, you can see that the S&P 500 AD line closed slightly above its moving average, as did the NYSE All. So that's slightly encouraging. You really need to see a couple of strong days. We had a strong day on Monday to start off with. It was about 2,000 advances versus 400 declines, but we closed only about 2 to 1 positive. So that was disappointing. Now, if you look at the weighted, the Spider Trust, you can see the difference here. Quite a move up. If we look at this on a monthly basis, it's up 3.53%. The unweighted was down 0.65%. So that's what the story of the market for June, basically. And, if we go back to the daily here, of course, this is the divergences everyone's continuing to concerned about. You have to, in technical analysis, you have to try to compare, though it's not always easy, the same sort of markets. And so, the S&P, AD line should be compared to both the Spider and the unweighted. Below the NYSE, different number of stocks in there. I look at it at the same time because it's unweighted, but really you can't compare it for divergence analysis. So if you look at the QQQs, which has been shot to the upside here in the past month on Nvidia, semiconductors, etc., you can see it also had sort of a slight reversal in Friday's trading. You can see this bar right here because it had a high of 487.20, a low of 468.46, and closed pretty near the lows at 479. Typically that has a sort of a negative bias heading into Monday's open. 20-day moving average here, the support level here is at 472.11. So, it's just 7 points. That's not much of a move. In the Qs, they went from 442, up to 486 within a couple of week period earlier in June. Below here, we have the NASDAQ 100 AD line. This is the divergence, got everyone worried. We peaked here. The average is the weighted average, has moved higher. The AD line is not weighted. It's back to the highs we had earlier, but all stocks in the NASDAQ 100 are treated equally in the AD line, not so much in the price. Relative performance suggests it's still leading the S&P 500. So this tells you that been a very valuable tool, all the way back to the end of 22 and 23. This was pointing out that the big tech was a place to be. Based on this analysis, it still is. Of course, you get a different look when you look at the unweighted average. So here we have the QQEW. That's the unweighted NASDAQ 100 index. You can see, we're still below the high from March. on an unweighted basis. It also closed off the best levels, and that fits right in with the AD line analysis. If you change this to, a close only chart, you'd see something very similar to this. Okay, so it's not bearish, it's not bullish either. If you see a strong move above this, that would be a good sign. Conversely, if you break below, the lows probably from the end of May, that's going to be the correction that everyone's worried about. Down, down to the new pivots for next month, which we'll have available on Monday's trading. Below here, we have a very telling development in the relative performance. So this is the relative performance of the unweighted QQEW versus SPX. No surprise, it's still declining. So, if you look at, would you rather be in the SPY or the unweighted? SPY, because it has that weighting. It's a weighted index and has all those big tech names in it. For a sharper correction, the high-low analysis is diverging. Okay, new highs, new lows, not based on market capitalization. So we peaked here, we made a slightly higher here, lower here. So that's not a healthy sign. In order to resolve that, we need to get above this downtrend and then above this prior peak. But as I talked about, if you go on the Viper report, there's a long article on past high-low analysis, and typically what you have is you get a trigger. That's when the new lows start to accelerate in the upside, and you have a divergence in the new highs. So we have the divergence, no surge in the number of new lows here. It's been a couple of days where, like on Friday, 135 new highs, 43 new lows. A couple of days before that, there were more new lows than new highs. So, we're looking for, I think, a move above 116 here as a warning sign. Pretty much the same picture from the NASDAQ composite. Spiked up here to a new high and then closed lower. So, a bearish reversal, but still no sell signal from the new lows and a longer term divergence in the new highs. For the first half of the year, technology and communication services were the stars. They were featured actually last November as the market was bottoming out as a couple of my favorites, and actually for the last couple of years, they're kind of the Teflon sectors. No change there. Everything looks okay, but we monitor them on a weekly basis for longer term holders, and we'll have long positions in both. Kind of a mixed bag. Financials have had good months, bad months. Same things for energy. Utilities had a pretty good first half of the year. On the downside, materials, discretionary, I think it's just coming back. We talked about the buy signal last week. Real estate has been beaten down, but as you'll see in a second, it gave some positive signs last week. So looking at the sector ETFs, XLP had a 3-day negative signal last week, and XLRE had a positive 1-day signal. You can see XLY, one we liked last week, is all green except for the 1 hour. And XLK, has a negative DTS but positive on the weekly and the daily. So we'll be watching it in case it should flip to a 3-day negative. XLST looks still pretty good. XLE is still pretty negative. We'd like to see a 3 DTS here, and as subscribers will see in the sector report this week, there are some positive signs in some of the energy stocks. So if we look at all the sectors, or all the ETFs rather I cover, you can see silver and tan, that's the solar stocks, etc., alternative energy, both had weekly negative signals, while EWY, that's Korea, and FDN Internet were positive. On a 3-day basis, KRE, regional banks, transportations, and KBE, big banks, all had positive 3 DTS. So we'll be seeing if they switch next week, whereas emerging market bonds, TLT, and the VDC and XLP were all negative on a 3-day basis. So that's all I have today. Tried to keep it under 15 minutes, but failed. I always like to hear your feedback at tom@viperreport.com. If there are things I didn't cover you would like to cover, let me know. And if there are things that I covered you don't care about, you can let me know that, and I might listen. Great. If you don't get a copy of the weekly ETF report and would like a complimentary, email me with ETF in the subject line, and we'll send you a free copy. Hope you have a great week. It's crazy week in trading next week with the 4th holiday on Thursday, jobs report on Friday, but we will have a weekly summary over the weekend. Thank you.